for the general public, if it's your goal and you want it bad enough, you make those sacrifices. Don't eat those avocado toasts and get your Starbucks coffee. No, I'm joking. It's just guys, welcome to another edition of Broadview Table Talks. We haven't done one in a while, so I'm excited for this one. And today is a pretty interesting topic that everyone's, I know you guys feel it, I know you guys hear it, and I know we're all living through it. It's inflation. Inflation and what the effect is on the real estate market. So with that, let's get started. Michael, tell me, what do you know about inflation?
So right now, we hear news articles all the time that says inflation is at record highs, and yeah, that's true. We haven't seen inflation rates this high since the early 90s. It's not necessarily a bad thing. It's just because of the circumstances that we're in, with a pandemic, with a war in Ukraine happening, there are a lot of things that are getting more expensive. It's understandable.
Supply chains and all that kind of stuff, right?
Exactly.
So they always say that, I think we're starting to decouple the interest rate hikes from the whole inflation stuff. As we're raising hikes, as we're raising rates, I personally argue that prices aren't going to come down anymore. I still don't think they are. With supply chain slowdowns and everything's just getting more expensive. Materials costs and wages and all that kind of stuff, right? So what are we going to do? What are we going to do with real estate prices?
The big thing about inflation is that, yeah, it's an indicator of what our economy is doing. It's growing. We always try to aim for 2%, but right now we're at 5.7.
5.1.
5.7 for February.
Is it really? Yeah. Oh my God.
So
it's not coming down.
The big thing right now is that, like you mentioned, the decoupling of inflation from interest rates is happening. Real estate is really not going to change because at the end of the day, it's not merely a factor of inflation or growth of money supply. It's really the lack of supply that's pushing prices up.
Yeah. Yeah. In fact, actually, I think that inflation is caused by the house prices, right? Because if you look at the basket of goods, the CPI basket of goods, how they define inflation, nearly 40% of that is coming from house prices. Yeah. Not from prices, but from the carrying cost of the prices, right?
Yeah, so that's when it's no longer a supply pull, it's a demand push.
That's
inflationary measure.
That's right. Buying more real estate, call it a day, end of podcast, done.
Yeah, call it a day. Really, the best asset that you can have during high inflation is real estate.
It's the biggest hedge against it, I guess, right? Like the thing is, what I'm saying is decoupled by from real estate prices, from the inflation hikes, is because realistically, just because they're going to jack interest rates, I just don't see the real estate prices coming down. I really don't. Like it's going to maybe
probably just level off a little bit. Yeah. But it's still going to go up, and it's not going to drastically go up like how it was January, February. It's going to just a steady rise.
Yeah.
But it's still the safest bet because you hold on to real estate. I mean, you go through the ebbs and flows, you're still going to end up on the better end of it regardless.
Yeah. Right. So everyone asks me, how's the market? I don't know if anybody's telling you they're lying to. No one knows what's going to happen in the future, right? Yeah. But what's happening, what I do see is that we were at a peak at some point since COVID. Things traditionally, the spring market is the best time to sell. Obviously, traditionally, there's the most amount of buyers out there, and depending if your place can compete, if it shows well, then it'll do really well, right? Average prices typically go higher in the spring. However, COVID's kind of messed that up, and we've been on a tearaway, on a runaway for the past 2 years. And now we're starting to finally see, because interest rates are going up and the buyer sentiment is kind of getting a little crazy, less people are buying. So it's kind of coming down a little bit, I find, from prices what we've seen for the past couple of weeks. There's not as many offers that show up on offer night anymore, right? We're starting to see things a little normalized. But if you look at it in the long run, you zoom out a little bit, yeah, it goes like this, but over time, it'll just kind of ebb and flow like this. That's what you're talking about, right? Over the long run, I think. So if you're buying real estate for the next 20 years, right, with a 25-year mortgage in place, you're not going to lose.
No.
Because guess what? Tenants still need a place to live, and they're going to rent it. Whether they're paying, I don't know, $4,000 or $3,500 or $2,000 versus $2,100, it's not the end of the world. You can make up, if you're still working, you can make up the cash flow by supplementing the real estate cost with your own income, right?
Yeah. And
go on.
I was going to say, and like you said, I mean, even though the ebbs and flows are going to happen, they're going to happen at a higher level and continue to go up. I mean, the easiest thing I would say to compare it to is with money itself. Someone comes to you and says they want to borrow $100, they're going to give you $120 back. You think it's great because it's a 20% return, but the fact of the matter is, with inflation, you don't know what's going to end up happening by the time you get that money back. If it's really going to be worth $120, it may not be. So real estate is the safest bet in the long run.
And funny enough, that's exactly what the government is doing with borrowing money, with printing money, I should say. Mm-hmm. So they're basically borrowing $100 from the Bank of Canada or whoever, and then they're printing more money so they create more, and then they pay back 120, but the $120
it's not worth as much.
May not buy as much anymore, right? Yeah. Like you see the price of everything go up. Yeah. So that's what investors are doing as well too, and that's why investors are winning. The ones that are doing it right. Because you're borrowing money, you're fixing the price, say $1 million for argument's purposes, right? You're buying a place for $1 million. You're paying that $1 million over the next 25 years. Yes, you're paying interest, but over the 25 years, by year 24, by year 25, whatever, you still bought it for $1 million. Yeah. Even though that could be worth $3 million at the time. Yeah. Mm-hmm. So that's why you're gonna win, I think.
When do you ever actually lose in real estate? Like you bought something and then it turns out,
to be honest, the way you lose,
people that panic sell. The market goes down so much, they panic and they unload at the lowest point or on the way down. That's when you hold on to it. You're gonna make it up in the end.
As long as you can make the monthly payments and all that, you still have a job that says, then you're okay. Like you should. Let's just say the prices go down. You're not gonna be like, oh my God, my house is not worth as much. But at the same time, you're not selling it right now. You know what I mean? So you're holding it out. So why not? Mm-hmm. If you still could make the payments, what's the point of selling? Just wait.
So you basically never lose.
Yeah. I wouldn't say you never lose. There's certain ways that you can lose. Yeah. And I think the biggest way that you would lose is through transaction costs. Because when you buy the place, you're paying land transfer taxes.
Yeah, lawyer fees, commission.
All that stuff, right? And then when you sell, you're paying commissions, right? Mm-hmm. So either way, if you do it quick enough, if you don't let the equity grow fast enough, then you're going to end up losing based on transaction costs. Mm-hmm. It's just the way it is. In the long run, you can't lose in real estate. Like I'll give you an example of a condo that I had over there. Before the pandemic, I was getting $2,200 a month in rent for 1 bedroom. Somebody left during the pandemic, and then I got $1,750. I tried, holding out, dropped the price slowly. Ended up getting $1,750 for rent, and now it's back up to $2,100, maybe even $2,200, really, right? So that tenant left, and we put it on the market, and I'll probably get $2,200 for it, So as long as you can hold out, if I panic sell during that time, I would have made a little bit of money, maybe even lost money, but over time it would have made sense. So it will make sense, I should say. Yeah. So $35,000 is your max you can withdraw from your RSPs. Max it out, right? Do whatever you can, save, max it out. Yeah. Shack up with somebody, buy the place with somebody, even if it's not your spouse. Maybe it's a partner they buy it with, a friend or whatever, right? Now combined, you can withdraw up to $70,000 in your RSPs. Now, what Bader was saying is that because you're putting that money down to hedge against your influence, you basically it's a tax deferral. So you basically take that off your income for the year, so you get a refund. Yeah. And you're saying up to $6,000. We got to do the math on it, but let's say $6,000 for argument's purposes, and you put on 1 year. Yeah. That's $41,000 per person.
Exactly.
Right. So now you combine with 2 people, you got $82,000 as your down payment. All right. Yeah. And you got to remember, if you're buying something in Toronto as a first-time home buyer, you don't have to put 20% down. A lot of people think you do. You could put up to 5% on the first $500,000, 10% on the next. From $500,000 to $1 million. So say you buy something for $750,000. That'll buy you a nice 1 plus 10, right? Or 1 bedroom, right? The down payment you got to put down is $75,000, right? Plus some CMHC costs and all the mortgage insurance and all that stuff. But that's your $81,000 right there with 2 people. Mm-hmm. Well, so you can't tell me you can't buy a property. Like you can.
And in fact, a lot of people say not to put the 20% down, to put the minimum payment down, because the money that you didn't put into that, you could actually invest somewhere else and get a greater return than just having it sit there.
And it takes longer to save 20% if you have the first 5%. What's the point of just exhausting it? Because even though there's CMHC fees, it's going to be all consolidated in the loan anyways, right? So,
and you get a better rate when you get CMHC mortgage insurance. So either you have over 35% down, or you have a CMHC or a Genworth or whatever, you have an insured mortgage, that's when you get the best rates. So you might even save on the mortgage interest. Yeah. I can't say there's an excuse to not buy real estate. Like for the general public, if it's your goal and you want it bad enough, you make those sacrifices. Don't eat those avocado toasts and get your Starbucks coffee. No, I'm joking.
It's just in Toronto, that's the thing.
It's expensive.
I feel like people could buy it, but the value, it's for it, that's the reason. Like a lot of my friends are like, yo, it's just too small, bro. or someone's 50. So
But someone's gonna live in it.
like
Someone's gonna live.
chilling.
Someone
They're
else
hoping
is
it-
going to buy it.
Yeah, they're
Yeah.
hoping it will get better, but I'm like, yeah, it's never gonna.
The more you hope, it's just an excuse for taking inaction and not doing action.
Sometimes it's just
they love
the priority,
city,
right?
But they know like they could get more for their money, like say for example in Texas. Or
So go do it.
but they
Do
won't.
it. That's what I'm saying. Go do it. And they won't. They'd rather go buy that Gucci belt
Yep.
or that
Yeah.
whatever. You know what I mean?
Yeah.
Like they'd
It's
rather
not
the
priority,
elbow
right?
purse.
Priority, what they want to do in their lives. So if you want to just spend whatever you could make, that's basically what's happening, right? They
It's
don't
instant
really-
gratification
yeah,
at the end of the
right
day.
away,
It's
yeah.
easy to get those luxury goods now because you want them, right? And
Yeah.
it makes you feel good. But if you have that delayed gratification and you wait till later, it'll pay off in dividends in the future.
100%.
Yeah, but it's also like I said in the other video was, you know, anybody can make excuses for whatever you're doing, whether it be real estate, buying real estate, working out, all that kind of stuff. Everybody can make excuses. And one of the things I say is, you know, don't wait to buy real estate and wait.
Yeah.
Yeah.
I don't mind not being fit anymore because I know the sacrifice it takes to get in there. So I'm just gonna wear baggier clothes. You know what I mean? Like, this is the way to do it. But ultimately, you know, I got my properties in line. I'm good. You know, because I took that sacrifice early and did it.
Yeah.
So hope you guys can do the same.
Yeah. I mean, same thing. Like the story that you know about is when we bought our first investment condo. Jacqueline found out she was pregnant with our first son, and you know there was a bit of like, should we get rid of it? Should we get rid of it? And decided to hold on to it. Now it's the best thing we ever did.
Yeah, you got options now.
Yeah.
Right? So that's the hedge against inflation. That's what we're talking about. You got to do it. Even if you don't buy real estate, there's a lot of good reasons to buy real estate. First of all, because you can leverage and all that kind of stuff, right? But just put it somewhere. Don't leave it in cash. Don't leave it in your bank account. It's not a good idea. You're going to get penalized for that.
Yeah.
Savers are the ones that unfortunately are getting penalized because of this whole way that the government's printing money, just diluting our currency base and just debasing our currency. You know, just printing more and more money, and it just makes it worthless.
Yeah.
Less more. And that alone guarantees that you're going to do well in real estate. So with that, signing out. See you next week. Talk soon. Thanks for joining us on Broadview Table Talks. Peace.
Add it up.